Did you know there are 3 big new costs for entrepreneurs in 2016 and that you might have to increase your sales by as much as 10% just to make the same cash as last year? And that many business owners don't even know about them. Hi, it's John here with another business boosting tip for you. And today I'm going to tell you about these costs that are due to hit this year. They're all as a result of government policies that hit small businesses. So what are they? Well, the first is the change to dividend tax. Most business owners pay themselves a small wage to use at their personal allowance and then use dividends to take money from the business. That's because it's really tax efficient. For example, there's no tax on dividends on earnings up to £42,385. It's one of the main advantages in having a limited company. But the tax on dividends is changing in April 2016. For then, you only get £5,000 of dividends tax free, but after that, there's a tax of 7.5%. And this extra tax carries through into the dividends in higher rate tax bands as well. So what's this actually mean? Well, as an example, if you pay yourself a small salary this year to use the personal allowance of £10,600 and then pay a £25,000 dividend, there's no income tax. In 2016-17, there'll be tax of £1,500 on the same dividend. Now, I am an accountant, but I don't need my calculator to work out. That's an extra £1,500 of tax on the same earnings. Now, the second big cost is the living wage. From 1st of April 16, there'll be a new living wage for workers aged over 25. This rate will be £7.20 per hour, replacing the current minimum wage of £6.70. And coincidentally, that's also an increase of 7.5%. Now, I was chatting to one of my clients the other day, a restaurant owner, and this impacts half of their current staff. But on top of that, it means the current wages of some of the other staff members will have to be increased. So it means that some of the wage rates will actually be out of kilter, out of sync with the experience of the staff. So as an example, if you've got a 24-year-old working for you, been with you for years, excellent worker, knows the business inside out, is paid £7.10, whereas a 25-year-old who's just joined is on £6.70. In April, that 25-year-old must have a pay rise to £7.20 an hour, so therefore, should you give the 24-year-old an increase as well? And the third change is workplace pensions. Now, auto-enrolment or workplace pensions have been announced a few years ago, but they're really hitting entrepreneurs this year. By now, you'd have probably seen the TV adverts with the fluffy multicoloured monster everyone ignores. This is because many people have ignored workplace pensions the past few years, thought it was something that was going to weigh in the future. But this year, you're really going to have to take notice, and by the end of 2017, all employers must have entered a workplace pension scheme or face heavy fines. In October 14, the pensions regulator applied the first of these fines. Three firms were fined £400 each for not hitting their enrolment deadline. But these fines were just the start. If you continue not to hit the deadline, you can actually face daily fines of between £50 and £10,000. So away from that, if you do get it right, what's the cost of workplace pension? Well, there is a lot of admin up front and then more admin to run it, but at a pure cash level, you could be paying 1% of staff wages into a pension in year 1, 2% in year 2, and then it rises to 3% of staff wages in year 3. Now, we have been banging on about this for a few years now in videos, newsletters, seminars we've run, but it's really speeding up. In 2016, there were over 500,000 businesses starting workplace pensions, compared to only 75,000 in the last 2 years. Therefore, it's worth getting it sorted, as the experts will be overrun as demand increases. So they're the 3 costs, but how do they all add up? A 7.5% increase in dividend tax, 7.5% adding on to some of the staff costs, plus 1% to a pension, and the cost of setting up. What's this all mean to you? Well, of course, it will depend on your exact details, but we've run a few scenarios, and the net effect is a drop in take-home cash of more than 10%, which means you'll have to increase your sales by 5 to 10% just to make the same cash as last year. So what can you do now? Well, the first step is to look at your figures and understand the impact on your business, and then to put a plan together to either increase those sales or look at other cost or tax savings. Now, I hope you found that useful. And if you did, I'd love you to share it on Facebook, Twitter or Google+. And if you'd like some more tips, and also actually to kind of perhaps talk about what you can do to mitigate these savings, please do get in touch using the details below. Thanks for watching, and I'll see you soon.